Good morning, you've tuned into ET Now. This is Buy Now, Sell Now. I'm Karunya Rao, with me is Cheryl D'Souza, and let's get started with how the markets are faring. And after a gap of 1, 2, 3, well, almost 5 days, we're seeing a bounce back come by on the benchmark Nifty 50 index. You have Nifty, which has gained 127 points at this juncture. It's trading firmly above 14,800. Sensex is up 422 points. You have broader markets also cheering equally. You have the mid-cap index up 0.9%. Small cap is up 0.8% in trade. All the sectoral indices are firmly in the green. You have Nifty Realty really charging up in trade. It's up 3.7%. Energy stocks are looking very upbeat, 2.5% higher for that. Public sector enterprises are up 2%. Nifty Metal Index is up 2% as well. You have some PSU banks also looking fairly resilient in trade, and even infrastructure names. From the benchmark index, it's ONGC, which is in top shape, the biggest gainer on Nifty 50 index, up almost 6% as we speak. Tata Motors in top gear once again. Strong commentary coming in from the management at the annual analyst day, up 4.5% for Tata Motors. You also have BPCL and GAIL gain in the excess of 3.5% each. Hindalco as well, very much in the limelight on back of their analyst day. IOC, L&T, Tata Steel, HDFC Life, TCS, all gaining in the excess of 2%. So Cheryl, looks like it's a very firm market and nothing really to complain of at this juncture.
Definitely, Karunya, 5 days of losing streak. That's what we've actually snapped in today's trading session. Good gains coming in for the benchmark indices as of now. But we have Kunal Bothra as well as Ashish Kapoor both joining us this morning. Good morning, gentlemen. Kunal, I'll come first to you. Looking at the market setup, do you think that we'll hold on to the gains? And also, what are your picks for our viewers today?
So good morning, Cheryl. Yeah, I think it's a good bounce for the index, a much needed relief rally, and generally and typically when we see bounces shaping up on the indices, it at least results into a couple of days of bounce for the for the overall markets. So I'm expecting that if today the indices close assumingly wherever they are right now, 14,800 and 35,300, 400 on the bank Nifty, then I believe that probably a probability of one more day of a bounce could not be ruled out. Many of the stocks as well have come back into some very strong support territory. So I think in that aspect as well, there should be a relative bounce into many of these names as well. Two stocks which I'm highlighting as buy candidates, and the first one which I'm suggesting is more of a contra play. So it's a Ban Escorts. Now the stock, I think from those 1 month highs, I think in Jan end and Feb start, which was at 1450 levels, has dropped almost 200 points. So a correction of more than 10 to 15% from its major swing highs, the stock has already shown. But I think at current levels of 1250 approximately, the stock seems to have come back into oversold territories. The 15% correction as well has sort of completed for the stock as well, and it's also coming back towards the price retracement support, which also arrives closer to this 1250 mark. So with the confluence of these three key indicators, I would suggest a Ban Escorts for a target of 1320, and stop loss could be kept at 1220 levels. The second is a Ban Cummins India. Now this is I would say a potential breakout candidate. Now, if you look at the last 3 months of chart patterns, the time when the stock had broken past about that 600 levels, the ferocious rally, took the stock back towards those, 750, 800 zone. Over the last 2 weeks, the stock has been consolidating. So a rally and then a consolidation. These are classical, technical patterns which we generally indicate it's more of a bullish flag pattern. And this consolidation is where a trader should try and take opportunity of. So I think at current levels of 750 approximately, Cummins India becomes an attractive buy. Would look out for at least a 10% upside from current levels. Would term this as a positional call. So targets of approximately 850, and stop loss could be kept at 737.
All right, so Escorts and Cummins from Kunal. Ashish, hi, morning. What are your bets for the day?
Yeah, I think the current correction does offer great opportunities for buying. in the market. We remain sanguine about the long-term prospects. I think this correction is a great buying opportunity. Amongst the ideas, one is Balkrishnan Industries, which has corrected significantly in the recent past. The company is focusing solely on off-highway tires, which are used in construction and agriculture. And in this segment, they have a very clear leadership position. In fact, they have a 7% global market share. The company's margins have been improving over the past few quarters. The revenue growth also has been very impressive. They're 30% growth in the last quarter. With the economy coming back to normalcy and agriculture seeing a buoyancy, we feel that going ahead, the company will continue to do very well. It is a very cash-rich company with zero debt. So it just remains a very good stock pick at the current levels. The other one is steel strips and wheels. The company makes automotive wheels. And again, the company is doing fairly well now. The last few quarters after the lockdown were pretty bad because of the shutdown at various places and automobile volumes dipping. But last quarter, we have seen a very good rebound, both in volumes as well as in profitability. The company is a clear leader in the alloy wheel segment, which is the high margin segment and is being used by all the high-end and good manufacturing cars these days. The company has amongst its customers nearly all the big auto players from Maruti to Tata Motors, Hyundai to Ashok Leyland, and also is catering to various export markets. A very broad base of customers and a very clear leadership in its segment and a growing segment. And company already has turned around and is come back to nearly pre-COVID levels in the last quarter. Going ahead, we feel that the pickup would be very significant, and this is another stock which is available at a very decent valuation and a very significant the price difference to the all-time high. So it's near at quoting at less than 50% of its all-time high. So the scope for upside appreciation seems huge. And in both Balkrishnan and steel strips, we feel a long-term investor can make a lot of money buying at these levels. I was asked about artificial intelligence and contract manufacturing. In contract manufacturing, we feel DV's Lab and Varun Beverages are the two stock picks which one can consider. Whereas artificial intelligence, you can go with Siemens and Wipro. These are two companies which have a very good presence in artificial intelligence. So going forward, and also both these companies are diversified. So artificial intelligence typically takes a long time to bear fruit. So since Siemens and Wipro both have...
All right. All right. Okay, well, those were the picks from Ashish as well. Let's quickly pull up the buy now, sell now stock cloud to give you a sense of all the individual stock names to keep on your watch list. Starting with Reliance Industries, one of the big gainers in trade. They've given a detailed thing about their plans for O2C reorganization. Reliance will be retaining control of 49.14% of O2C. There will be no dilution of earnings post the carve out. You also have Tata Motors, like I said, in top shape after strong commentary coming in on margins, visibility and FCF generation going forward. Hindalco also held their analyst day and they've given some interesting commentary. We'll get you more details through the course of the show. Bharat Forge, another stock to keep on your radar. They've signed a pact with Paramount Group for armoured vehicles in India. Muthoot Capital, some bulk deal action that took place. Saif India Partners has entered. Emphasis also in the limelight on back of news flow. From Economic Times, we pick up that Carlyle has tapped bank and funds for the $3 billion emphasis buy. Info Edge, another stock to keep on your radar. Zomato has closed the $250 million fundraise from 5 investors. UPL, Zuari Agro, two names as well to keep on your watch list. And finally, there's ONGC, the top gainer on the benchmark index, rallying on crude surge as long positions pile up. These are the stocks to keep on your radar as part of our buy now, sell now stock cloud. Before we slip into a break, let's get you an excerpt from the Mega ET Now exclusive. SBI's top boss says the bank will keep home loan rates competitive to push the segment. Mr. Khara believes a fine balance must be maintained on fixed deposit rates so that both the economy and the people dependent on interest income are taken care of. Listen in.
See, when it comes to the liabilities, that is the rates are also a function of the inflation. More so in an economy like ours, where a very large population does not have the benefit of any kind of a social security. So for them, the interest earned on the fixed deposit of the bank, or for that matter the postal deposit, is actually the main source of earning on an ongoing basis. So I think there we have to keep in mind the interest of very large segment of depositors also in mind. But at the same time, it's a very fine balance which you have to maintain always. Where ours is an economy which is a growing economy. We have to ensure that the interest rate for the lending also should not go up significantly. So that is something which keeps on busy, keeps all of us busy, and in ensuring that the fine balance is always maintained. So I would expect that if at all going forward, the kind of borrowings which have been envisaged by the in this budget, of course RBI is very, very cognizant and is very, very focused and conscious in terms of ensuring the yields. So I think keeping that in mind, even RBI is also trying to maintain a balance, a very fair balance, so that the economy, I think for the growth, these are the essential imperatives which all of us are trying to address. If we look at all these factors, perhaps I would say that the interest rates on deposits and maybe home loan for some more time to come, we should be in a position to maintain at this rate. But yes, of course, as far as deposit rates are concerned, I would say that it seems to have bottomed out.
Welcome back. You're watching Buy Now, Sell Now on ET Now. Good day for the markets. Snap the 5-day losing streak. But let's get on board now for our viewer queries. The first query coming in from Lakshman. He wants to know, he wants us to suggest him stocks with a 10-year horizon, specifically from the contract manufacturing, IT or the other spaces. And also he wants to know what should his investing strategy be. Ashish, I'll come first to you with this query. So definitely if you look at the question that our viewer is asking, looks like he's a long-term investor, wants to know about stocks for the next 10 years, particularly in contract manufacturing, IT sector. So what should his investing strategy actually be like?
Well, actually, I have kind of answered this question because I didn't realize it's a viewer question earlier. When it comes to contract manufacturing, I think DV's lab has a very time-tested model in the pharma space. They have been doing very well, though there are many other players which are coming up like Loris Labs, etc. But I think DV's would be the safest bet. And with a 10-year perspective, one can bet on it. It has been doing fairly well and has a very well-established practice. Growth has been good. And in pharma is one space where I think the contract manufacturing strength of India has been well established. So companies in like DV's lab, which have been doing well, I don't see any reason why their performance would falter going ahead. With a 10-year perspective, I think a very safe place to park your money in. The other one is Varun Beverages. They are basically, producing for Pepsi and also bottling for them and other software manufacturers. So that's another very interesting model, and growth has been very amazing over the last few years. So another the contract manufacturing bet which you can bet on, and the company has been fairly consistent in its growth over the past few years. So does augur well going forward. When it comes to the IT or specifically the artificial intelligence space, my take is that they are very niche companies and difficult businesses to forecast, but best to go with already established companies in their respective places which also have a fairly good artificial intelligence exposure. One of them is Siemens. Siemens otherwise is an engineering and a capital goods player, but it also has an artificial intelligence division in it. So that when you buy Siemens, you buy a whole lot of, get an exposure to a whole lot of segments, including artificial intelligence. And again, this is a fairly good, well managed and a well diversified stock to invest in with a 10-year perspective. The second one which comes to my mind is Wipro. Wipro again mainly into IT and various other industries, but also has artificial intelligence exposure. Again, Wipro has somewhat underperformed the other IT majors, but seems to be turning around with a new management and CEO in place. So this could be another very interesting and a safe stock to bet on with a 10-year perspective. So these are I think the 4 ideas which you can bet on in the contract manufacturing and artificial intelligence space.
Right. All right. Thank you, Ashish, for answering the query for the viewer. Kunal, I'll come first to you. Which actually stocks would look good on a 10-year horizon when it comes to the contract manufacturing and the IT space particularly?
So, Cheryl, there are a lot of ideas, frankly, from this space. So it's difficult to try and handpick and choose just a couple of them. But I completely agree with what Ashish also mentioned in few names, Siemens. Many of these other stocks like L&T, etc. From the IT services specifically, I think names like Wipro, Infosys, TCS, HCL Tech, I think these are very strong, kind of breakout candidates. What we've seen potentially for the IT stocks for a good part of 2020, in fact, the second half of 2020 particularly was a big breakout, a multi-year breakout for these names. And, these stocks are now going through their own phase of correction consolidation. So I think these are best opportunity and best times to try and buy these stocks in terms of portfolio for someone who's missed out buying these stocks in the previous 2 quarters. So I think in that aspect, I would also second many of the names which Ashish discussed upon. I think Wipro has been one of the stocks which I have been consistently recommending from a longer term basis. So the stock has also corrected from 460 or 470 highs, if I'm not wrong, to 420 levels where it's currently trading. So these are good levels where traders can try and take opportunity of a 10% correction from a previous high. Should be a good starting point for someone who's looking to accumulate from a longer term basis. So I think quite a few opportunities to look out for, and I think even if you stick out with large cap names with a horizon of 5 years, 10 years plus, then I believe that there should be a good enough opportunity to try and make some very strong and stellar returns from these names itself.
Okay, all right. Let's move on to query number 2. It's a Twitter query coming in from Puneet Malhotra. He wants our experts' advice on Sandhar Technologies and Sterling and Wilson. His time horizon is 2 years. Kunal, let's come to you first for Sandhar, and then if you could also talk about Sterling and Wilson. For Sandhar, definitely it has been a decent move in the recent past, but largely I would say, Kunal, since December onward, it has been range bound and it hasn't shown the similar kind of spot that several other auto and auto ancillary players managed to do. Talk to us about what would be your call on this one. Should one enter into it if they have a slightly longer, say 2-year time horizon, or are they better players to consider?
I think I frankly don't track both of these names, Sterling Wilson as well as Sandhar. And I was just looking at the charts as well. It's not something which is very, very intriguing in terms of charts. These stocks, they tend to be a bit lower, illiquid. So the liquidity is a bit lower than what you typically look out for in terms of these stocks. And as well, I think the trends for these stocks are more or less consolidation type. So it doesn't augur very well, at least on the chart front. And I would probably look out for recommending some other names and some of the stocks which have very strong potential chart patterns. So from the auto pack overall, I think something like Motherson Sumi, Apollo Tires, or you can look at maybe Apollo Tires or JK Tires depending on your risk appetite, and then look at Tata Motors or Tata Motors DVR. I think these are the 3 key verticals where you can definitely look out for, especially from a longer term view. These 3 key spaces, Motherson Sumi from the auto ang space, Apollo Tires or JK Tires from the tire space, as well as Tata Motors from the four-wheeler space as well. I think these stocks look fairly attractive, and they've given some very strong breakouts on the recent time frame charts. So now it's just a matter of time and patience for someone who's bought these names. I think because the structural patterns have improved significantly, I believe that there is a strong probability that over the next couple of years, these stock can give very strong upside. So I think I would recommend these 3 key sectors and the specific names which I just mentioned.
Okay. All right. Your view on Sandhar and Sterling, Ashish, what would be your advice to Puneet?
Well, Sandhar, I agree, is a very small player, and to that extent, I agree that it will not immediately bounce back with any rally. But if you look at the fundamentals, yes, and if the investor has a 2-year time horizon, I think he should certainly stay invested, because I think once the bigger auto players have played their part, I think the rally would shift to the smaller ones. Sandhar is certainly one good idea among the smaller auto component players. The company is basically made to manufacturing automotive locks, mirrors, and some other components mainly used by the two-wheelers. So it supplies mainly to Hero MotoCorp and Royal Enfield and TVS. The company would be a major beneficiary of the uptick in the two-wheeler industry going forward. And also, one can be bullish on it because they may plan to move up the scale and focus more on high margin products like rear parking sensors, rear view mirrors, and also tire pressure monitors. So I think it's not bad at all at these levels. Yes, because being a smaller player, it may not have participated so far, but that doesn't mean that the fundamentals are lacking. I think it's just a matter of time, given the way the bull rally is shaping up, that these stocks would catch the fancy of some investors and would start participating in the rally. So certainly a hold from my side as far as Sandhar is concerned. Coming to Sterling, and yes, that I agree that although the company is a global player in the solar EPC business and has a huge market share in the photovoltaic utility segment, but the financials are continuously deteriorating and does not inspire confidence. So yes, that is a stock where you should book out and sell out and move your money somewhere else. But Sandhar, you can certainly stay invested in.
All right, Ashish, thank you for your views on Sandhar as well as Sterling and Wilson. Moving on, let's get on board our next viewer query, and this from Biju Jacob. He wants to know whether he should invest in PNB Housing Finance at current market price. Kunal, PNB Housing Finance, a couple of news flows actually coming in over the last few days on that particular counter. But is it worth investing at current market price? What are the charts indicating?
I think it's a decent chart. Yes, this month, and I think last week or so, the stock had seen a very strong rally from 350, 370 levels to almost, at one point, rising 100 rupees higher, 470, 475 was the, very, very recent high for PNB Housing. But then again, this has been one of the stock which has been going through those cyclical downtrends last 3 years, from being a, 1600, 1500 plus rupee stock. The stock at one point, fell to almost 100, 150 rupees. So it has a history of, going through those sharp periods of correction. It's now in the process of repair and recovery. So I think this is the first stage of a repair and recovery for a stock like PNB Housing, and there should be room for more upside. Assumingly if the entire financial services pocket or the basket does extremely well on the long-term basis. So I think not a bad bet from from a longer-term perspective, PNB Housing. But I think again, as a strategy or in terms of levels, I would advise that you have a buy on dips kind of a strategy over here, because the stock seems to be having a tendency of going through those odd phases of correction. 330, 350 is seemingly a strong support for PNB Housing. So if you can buy on dips at least towards the 330, 350 level, I think that could be a much more prudent strategy for the stock.
Ashish, do you concur with Kunal's views on PNB Housing?
Yeah, I concur with his views. I think it's a good stock to buy for the long run, and an SIP kind of an approach would be better. Buy on all dips, buy regularly on every decline, and try and accumulate at whatever best price you can do by averaging would be a key thing, because yes, the stock is volatile like other NBFC players. And yes, housing finance is a very good story going forward, one of the better segments to focus on within the finance space. And PNB Housing is an established player. Returns have been good in the past, and I think yes, use volatility as your friend and buy in a staggered way on every decline.
Okay. All right then. Moving on to our last and final query of the day. HS Prakash writes to us. He wants to know about the merger math. He said now that Corporation Bank is merged with Union Bank of India, what happens to the shares and what is the outlook going forward? I'll just ask Ashish on this one because it's a very specific merger-related query and the prospects of the bank as well now that it has merged into a larger entity. Ashish, your view then?
View is simple, and I think I'm very clear on this. You look at the history of public sector banks. The current rally, according to me, especially in the smaller ones like Union Bank or Corporation Bank or similar banks like that, is that this should be used to exit and not try and buy more or try and hold. Look at their 10-year, 5-year, 15-year, any longer time period, public sector banks have been wealth destroyers. And regardless of whatever might happen, I don't see much of the things changing in it, despite talk of privatization and everything happening. Chances are that they will continue to be underperformers. So use the current rally to exit. Now, if you really want to kind of diversify your portfolio and have a public sector bank in your portfolio, the only one which is worth considering is State Bank of India. So if you are really keen to still have a public sector bank, move out of your current holding in Corporation Bank and buy into SBI on every decline. That is the only public sector bank which has created some wealth over a period of time and perhaps will continue to do so. Other than that, I think the very clear thing that this rally excitement over privatization is a clear exit opportunity for all investors who are stuck in public sector banks.
View on the public sector bank as a whole and saying that SBI looks the best among the public sector banks. All right, on that note, thank you, Kunal, as well as Ashish for joining us, giving us your take on markets, sharing your top picks, as well as resolving the viewer queries. All right, on that note, we'll slip into a break in this edition of Buy Now, Sell Now, but stay tuned, more news on the other side. Don't go anywhere.
Welcome back. You're still watching Buy Now, Sell Now. Let's pull up the Buy Now, Sell Now stock cloud real quick to get you a sense of all the stocks to keep on your watch list. Okay, let's talk about some stock-specific updates as well. As we flagged off, Tata Motors is in top gear today. They held their analyst day yesterday, wherein they talked very much in detail about their plans for the India business, especially the PVs. Poonam joins in with all the highlights and how brokerages are digesting that.
Well, a lot of positive takeaways coming in from Tata Motors analyst meet. In fact, management has gone ahead and reiterated the guidance of better profitability and free cash flow generation, and they have reiterated the target of reaching near zero debt by FY24. In fact, in the CV business, they expect to maintain leadership as well as improving structural margins. Turnaround is likely to be led by demand revival, better pricing strategy, as well as structural cost reduction measures. In fact, in the passenger vehicle business, the management has guided for a passenger vehicle EBITDA margin in high single digits over the next 3 years. They also expect that the free cash flow break-even would be in FY23 and it would be positive thereafter in the PV business. They expect to maintain leadership in the evolving segment like electric vehicles, and they plan to launch more models. CLSA, in fact, has gone ahead and raised the target price from Rs 345 per share to rupees 400 per share and they maintain a buy. They value the India business at rupees 186 per share and GLR at rupees 215 per share. They have gone ahead and also hiked the EPS estimates, and management also does expect higher commodity inflation coming in the first half of FY22. However, that should be offset by price hikes as well as better operating leverage.
All right, thank you, Poonam, for the analyst meet takeaways of Tata Motors. That particular stock is up over 4.5%. Moving on, you also had Hindalco that held its analyst meet yesterday. Mubina is here to take us through the top takeaways from that meet. Mubina?
Well, expect a more generous dividend from Hindalco. That's what they've announced at their investor meeting, which was held virtually. It was not just about dividend, but how the company will grow going forward as well, what sort of capital expenditure that they will be, incurring, and on what kind of projects. So largely, they have estimated an average annual free cash flow of $1.2 billion over the next 5 years and a capex spend of $2.5 to $3 billion over the same period. So let's understand how are they going to be spending this cash flow. So it's about 50% of it that's going to be utilized towards growth projects, 30% on debt reduction, and 8 to 10% will be utilized for dividends. This is definitely larger compared to the current policy where they were paying out 10 to 30% of the standalone net profits. As per Macquarie, this would give a boost to dividends by 2.5 to 3 times in the hands of the shareholder. On capital expenditure, it's going to be concentrated on downstream projects. So a little over $1 billion towards downstream capacities and $1 billion for a Novelis expansion project, which includes an all-important $300 million China project, which is important for the Aleris synergies really to kick in. Now, Macquarie has maintained their outperform stance with the target at 352 rupees, as they as well note that the capex and the growth projects are centered around the, the downstream facilities, which will be ROE accretive, though mind you, the management has not given any guidance on that front. And they have said that, there is structural domestic growth potential and that they will also be leveraging Novelis's capacity. So essentially, Hindalco is focusing in on where does India's growth potential lie and targeting that.
All right, thanks for that, Mubina. Let's also talk about Reliance Industries, another big newsmaker for the day. They've announced O2C business demerger ahead of Aramco deal. We took an analyst view on the same as well. We caught up with Devin Choksi. Here are his views. Listen in.
Well, I think the few things which comes out very clearly from this particular announcement, which has come up on the presentation on OTC, I think one important aspect is that Reliance as a parent company to its subsidiary OTC, they basically transferred the assets against a loan of $25 billion. And this loan is basically marked at, I think, the SBI MCLR rate. So obviously, I think they are going to make earning out of this particular loan. I think analysts had this particular point in their mind that how is it going to get rewarded to Reliance as a parent company shareholder. I think this probably answers first part of the question. The second part of the question is that they have categorically stated that Aramco deal is moving. And I think that is what the people were doubting about. So in this particular presentation, even the company has put in a commitment in writing that it is moving in a direction of getting monetized at some point of time. And considering the fact that I think $25 million worth of loan.
Sumit Nagar of Malabar Investments is bullish on the prospects of AU Small Finance Bank. But what's the rationale behind it? Listen in.
AU Small Finance Bank, right? So again, very differentiated, operating in a part of market where banks generally either don't operate, or if they operate, they just do it because they want to be present in there, right? That's not their area of specialty. And, again, whenever it requires you to be on the ground, require you to evaluate sort of the on-the-ground businesses of, small companies, that's where banks just find themselves in discomfort. And that's the backdrop where AU comes from. And that's what sort of gives them that specialization. So again, that's a company that we've liked. I think it's a company that we allocated significantly to during the decline, and that franchise sort of continues to do quite well.